Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
My highlight of the day, Jamie Dimon, a lot to talk about, JPMorgan Chair and Chief Executive. Thank you so much for hosting us again at your Global Market Conference. What's market turbulence looking like right now? So we have the CPI print yesterday, markets rally. Are they getting ahead of themselves?
Yeah, so I wouldn't call it turbulence. We've had good, healthy markets for quite a while. They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets which are kind of wide open. That's all good. It doesn't tell you what the future is going to be. I mean, I can point a lot of times in history where that was true, and the next year it wasn't true, and so we'll see. I don't pay as much attention to monthly numbers as most people do.
I know. So what do you think the future is for inflation and interest rates?
I'm a little more worried about it. I mean, we've had very big fiscal deficits. And, I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. The green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that, may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously, geopolitics is a whole different issue. That could be determinative in what our economy does next year, and we're just not going to know. But
so does that mean you think it's 50-50 whether the Fed cuts or hikes next time around?
Yeah,
the next move?
I really don't pay that much attention to that. The Fed will have to follow the data, and I don't know what the data is going to say, but I think they are doing the right thing to be patient right now. See what's going to happen. They may not know for a couple of months.
But no big correction. I mean, if you don't pay that much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high, and I think the chance of inflation staying high or rates going up are higher than other people think. So I think the chance, my view is whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Where does that happy talk come from?
Low rates, central banks are going to reduce rates. Maybe the geopolitical things disseminate, don't cause problems. And so, the future isn't predictable like that. So, I'm a student of history. I've watched all the inflection points. If you go back, my dad was a stockbroker. I go back to the booming markets of 72 and the collapse of 74. The healthy markets of 80, the collapse of 82. The 87 market crash, the 1990 real estate crash, and almost all of them were not predicted the year before. So I look at these factors that drive these things. They're not always known. As a company, we prepare for all of this. We can serve all our clients regardless.
But what do you see as the main stress right now? Because if it's geopolitics, we talk about it. It's just not really priced in. Is it distress? Is it something actually going under that you worry about, or just multiple factors coming in at the same time?
No, I think geopolitics could create the main stress that we're worried about in terms of oil and gas prices, trade alliances. But I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
So is unpredictability the new normal?
I think it's been the norm since my whole life.
Has it?
Yes.
Not worse now?
No.
What happens between China and the U.S., and what does that mean for your appetite of being China?
Yeah, so the geopolitical situation is very tense because of Ukraine and Russia, Iran, the terrorist activities in Israel, North Korea, nuclear blackmail. We've never had nuclear blackmail before, and this is, of course, affecting our relationship with China. And it's going to be hard to have a great relationship with China as the Ukraine war is on. We're kind of on different sides of that. And put Taiwan aside. Having said that, I think it's the right thing for America to fully and deeply engage with China, competitively. Every nation is going to do what's in their own interest for national security. So should America. We should define that fairly and properly. If there's unfair trade, negotiate that or do whatever you need to do. But the engagement is the right thing to do. China is not a natural enemy of the United States. They have a lot of their own problems. So, to me, we can work together as best we can. And then we have common interests: climate, anti-nuclear proliferation, anti-terrorism.
But what does it mean for a bank working in China, actually, given all of this volatility?
They're cautious. I mean, China, if you look at China from a risk-reward basis, it used to be very good. It's not so good anymore because all these things can go wrong. And remember, we bank, I forgot the number, but 1,500 multinationals in China. They're not leaving China, so we're going to serve our clients there. We're just much more cognizant that the risk is higher. And I put Hong Kong in that bucket too. We kind of look at China, Hong Kong as one at this point from a risk standpoint.
What does the Trump administration mean for the U.S. economy?
I don't know.
Why? Because it's unpredictable, or because we're too soon to actually trying to figure out the policies that he would put in place?
So if you look at history, who was elected president may not necessarily affect the next year. That's kind of like we're a big tanker and that's going to happen. I think the much more important thing is what we do in the geopolitical situation. I've always been quite clear that American leadership is provided to keep the world free and safe for democracy. And that means economic alliances, which includes trade, by the way. I think we should spend more time in trade. It means NATO. It means that Russia should not win in Ukraine. Because if they do, I think it can tear asunder this Western world.
I know you've ruled out being Treasury Secretary.
Yeah.
Why? What would it take to get you into politics?
I don't think I'm suited for politics. I love my job, and so I'm not sure I want to do something like that. And I can hopefully.
But even if you got the call, would it be hard to say no?
I don't know. Probably yes. I love my job, and I have no interest in leaving or doing anything else. So.
We're in France at a global markets conference. What are you expecting from Basel III? What will Jay Powell put in place in the new rule book?
I should mention, by the way, because President Macron has done an outstanding job here. Pro-business, got us to move our trading floors here. He wants to grow his economy. There's much more innovation. We had a thing last night about innovation. So, look, Basel III, we've been quite clear. We thought it was excessive, not well thought through. I would love to know what the end game is. What are they trying to accomplish with private credit? What are they trying to accomplish with, like even the other day, 80% of mortgages left the system, and now the government is talking about having a bailout system for mortgage companies because they're no longer in a bank that has the ability to provide liquidity in tough markets. That would be the same thing in market making. So they're looking at it. I trust Jay Powell to look at and analyze what they need to do, how they need to do it. The other thing, which I'm not sure Europeans know, I have no idea. And it may end up in a lawsuit or something like that. But the amazing thing to me is that America ended up, the end game, 30% more capital than a European bank in America. And I just, why are we arguing about international standards and then we simply don't do them? And also, I think the regulators should answer the question, what do you want? How do you want the system to work? Do you want it to private credit or public credit? Do you want mortgages out of the banks? Just dictate it. If that's the goal, just dictate it. If you don't want leverage lending in the banks, just dictate it. And I think we are guardians of the financial system. We bank 100 countries, and we're on the ground in 60 countries. We do great work for cities, schools, states, hospitals, solar, wind, climate, middle market companies. Is that what they don't want or they do want? They want to make it more expensive.
But they know,
companies?
or are they still trying to figure it out?
I think they've got to figure it out. I don't think it's quite clear from any analysis they did. You guys should read it and write about it. There was no detailed analysis about cost benefit, what they're trying to accomplish, what the outcome will be.
That's why we're asking you,
right.
Jamie. Talk to me about France. So you're positive on the president, Emmanuel Macron. I also know that you were at the Choose France event on Monday. If he relaxed labor laws, would you hire more in this country?
He did relax labor laws.
But if he relaxed them more?
Possibly. We now have 1,000 people here. We have large trading floors here, which trade, I've got the number, $5 or $6 or $7, $800 million a day. When you have 1,000 people, you tend to hire more. More technology, more, and that's been true for us since I've been at JPMorgan. Once you have a very competent group of people and you have hiring and capability and friends, you tend to do more things there. So my view is we will be doing more things here. And it was the tax law they put in place, the regulations they put in place, the labor flexibility they put in place, those things do make a difference. And very importantly, they don't just lift up JPMorgan here. We pay a lot of taxes here, which help lift up all citizens. I don't think President Macron did that for JPMorgan. He did it because he knows his country needs to grow, bring in innovation, and that's how you build a better country.
So the chief executive of the largest wealth fund in the world says that actually America's doing much better because Americans are less lazy or work harder than the Europeans. I mean, is that fair? Is that regulation?
I hate total blanket statements like that. I know a lot of Europeans who work hard. But I think when you see the thing about work hours, I think it is somewhat true. Americans are hardworking. Anywhere you go around, Americans are hardworking. But I see that here too. I don't think, and the innovation people you meet, they're working just as hard as the innovation people in the United States.
So you also, in terms of headcount in the UK, I think it's at the highest that it's ever been, and you're also you're giving money to try and retrain. You've recently met with possibly the next Prime Minister, because he's so far advanced in the polls. What do you think?
Look, I like the fact that both the Conservative and the Labour governments are talking about pro-business, simpler regulations, getting more innovation in the country, becoming competitive, and we all have too much debt. Growth is the best antidote for everything. And so having a growth strategy is good for a country, and it's good for the lower income people. And this training stuff is maybe the most important, to get training, jobs. That first job is a first rung in a ladder, creates dignity, more household formation. And I think countries have to do more of that, because if they don't, you can have a tough time.
But do you think the UK economy will change under Labour?
I don't know yet, but I was happy with what they were talking about. We had Rachel Reeves come to our conference too, that they're all talking from the playbook. We need growth, simpler regulations, more capital formation, more capital investment, meaning proper taxation, because that's the way to help our whole country and all our citizens. So that is what we should all be doing.
Jamie Dimon, we talk around, India all the time. Is this a decade for India, and does it somehow counterbalance China for, world growth?
Yeah, look, I think India has done a very good job. And when you look at India, yes, it should have a very bright future. I'm not saying it's a counter to China, but a very bright future. And I think we should all be reaching out to India. That, they have to stay non-aligned because they're kind of where they are in the world between Russia and China. But they're a democracy. They're a natural friend of America and the Western world, and we should all be helping them. And they've made a lot of changes there, infrastructure, transfer payments, 700 million people bank accounts that are going to be very good for that country.
So what does that mean for JPMorgan?
Well, we're not in the retail business there, but
will you be in the future?
We have 60,000 employees there. We got big campuses, high technology, and we're expanding our trading, our research, our investment banking. Yeah, we're there in a big time. Yeah.
Can you talk to me a little bit about JPMorgan and how, you've had a number of high-profile departures. How does that change actually the way you focus, your business and how you run things going forward?
Not at all.
Nothing? Zero? If you were to buy anything, what would you buy?
Oh, that's different. Look, we can't buy banks. You do know that. So
Well, you could buy your European bank. Could you?
I wouldn't even try. I think the American regulators would hate it. I think the regulators here would hate it. Even if they said, go ahead and do it, I'd probably be in courts and things for a year and a half. Huge distraction to my own company. I'd rather just say we want to add clients in this country and clients in that country. We'll add bankers and technology and branches. It's just a better way for us to grow.
Okay, but if you could buy anything, not a bank.
I can't tell you.
But you were thinking of something?
Yeah, we always look at stuff, yeah.
What region?
We're not looking at any major acquisitions or anything like that.
Technology?
Right now, if you look at what we're doing, we're adding literally, we have Investor Day next week. We're adding retail and wholesale branches. We're adding them in the United States. We're in almost all the major 100 cities there now. We're adding commercial banking all over Europe and Asia. We're adding technology around payments and even a blockchain called Onyx to move data and maybe move money one day. We're constantly investing. We have 2,000 people in AI and machine learning, 400 use cases on the way to probably 800.
I know. So if I speak to you in 5 years, how much bigger and how much different will you be?
You'll probably be speaking to a fake diamond who's just answering questions.
What, an avatar?
An avatar, yeah.
Do you think about technology a lot?
Yes, all the time. Every meeting we have, this has been true my whole life, when we have any management meeting, your technology agenda is on the table. That includes AI, cloud, just more analytics. What are you doing to do things better, faster, quicker for clients? Digital. a huge amount of digital services, integrating them better, automating them better.
But that would change. I mean, that will change, I guess, the heart of banking. Does that mean that you'll see more winners and losers because of the technological advancements?
So technology has always changed. The heart of banking, moving money, holding money, advising money, raising, that won't change. And you have to do that according to rules, laws, regulations by country. What will change is how you deliver it. So like right now, you go on your phone and you can move money and buy stocks. That wasn't true 20 years ago. So yes, everything you do will change because of technology, but you'll still have to move money, budget, raise money, make investments, et cetera. So, the core won't change.
But will it change?
And regulations may change that too, obviously. So
in the U.S., so again, would a Trump presidency be more favorable to banks when it comes to regulation?
I don't know. I mean, I am unhappy with the amount of rules and regulations coming out today. I don't know what a second administration of either one would do. I'm hopeful that they focus on growth, which is good for the citizens, which is good for the country. And I would help anyone I can to do that for my country. I'm quite patriotic about that. And I do think you need to help.
In terms of serving?
I think you need to, helping.
Oh, helping
no.
as the bank.
Yeah, exactly.
It's good to get that clear.
Exactly.
Good friend of ours on this program joins us now for more. Mike Collins, let's start with yesterday and talk about what that data means going forward from here.
Yeah, Jonathan, good morning. Thanks for having me again. Yeah, I think we're just moving in the direction we've been expecting, right, which is slight moderation in growth, down toward 2%, maybe a little bit below 2% this year, and a continued moderation in inflation. I mean, if you strip out, we're back to stripping out shelter again, right? Because that continues to be sticky, running, closer to 6% than 2 or 3. If you strip that out, both headline and core CPI year over year now are back in the low to mid 2s. So we're moving in the right direction. That's our expectation, that the shelter component will probably get cut in half as the year goes on, from close to 6 to closer to 3. So I think it's pretty good news on all front. The question is, as you heard from Williams this morning, why does the Fed need to do anything? I mean, we're in the 0 to 2 cut camp now, as you just indicated. And I don't know. I mean, I think 0 is probably the highest probability of a 0, 1, or 2 if you had to really push me on it. The Fed's MO historically has been sit on your hands, don't do anything until you're really forced to move, until the data really points hard in one direction or the other, and it is not doing that.
And Mike, I want to push you on it. I've got a quote in front of me from you at the start of April. You said this: the economy continues to be solid, inflation continues to be sticky and well above their target, the labour market is still rock solid, financial conditions are the easiest they've been since the Fed started hiking. Why would you cut interest rates with that backdrop? Mike, is that quote still your quote right now? Would you say exactly the same thing?
Absolutely. Now Powell is a dove, right? He is a labor market economist, kind of trained under Yellen. That's his MO. He's very sensitive to getting pushed from the left about the job market. If things change, and things can change rapidly, as we all know, Jonathan, if things change and the labor market really starts to weaken over the course of the year, then sure. A cut or two are definitely in the cards. But right now, the way the data is pointing, I would certainly still stick to that statement that their MO is to do nothing until they're forced to. And again, with the election looming, they start running out of dates, as we all know. So that's definitely part of the calculus.
Mike, we've been playing around with what this means for riskier assets, and a lot of people have had conflicting views about how much it actually matters, since we're seeing a stickiness and a lack of potential rate cuts this year because of positive economic trends. From your vantage point, does this push you further into risk assets and credit, or maybe make you a little concerned, hold back?
Yeah, we're continuing to be pretty defensive in credit. We're continuing to cut back. In fact, our recent trades have really been to continue to reduce exposure to corporate credit and increase exposure to things like, believe it or not, old-fashioned government-guaranteed agency mortgage-backed securities. where they have been a big laggard, not only this year, but over years now, relative to corporate credit. And they actually have some technical and valuation dynamics that actually look pretty appealing, right? If interest rates fall, if you get a weakening in the economy, which again isn't our base case, but mortgages would actually outperform corporate credit in my mind in that scenario. So again, that's an up in quality trade. That's a up in liquidity trade. That's a more defensive trade. And that's generally been our direction of travel.
It raises this interesting point about whether the biggest risk is not a reacceleration of inflation anymore, whether we've basically taken that off the table. And now people are just looking for the timing of when things slow more materially, which is the reason why people are getting bullish on duration. Is that essentially your baseline presumption?
Yes. I think the upside risk, we're there. We've had it. We've had the big boom in nominal GDP. We've had the overshoot in real growth. We've had the overshoot in inflation and nominal growth. We've had the overshoot in interest rates, Lisa. And I think, when the markets just a few weeks ago were pricing in a permanent funds rate of around 4%, as the low terminal rate for the next 10 years, I look at that as an overshoot, and that rates were 50 to 100 basis points too high. And then look what just happened. They rallied 40 basis points really fast, right? So now maybe they're still 0.5%, higher than what I would say is fair value, which is probably more in the mid to high threes, let's say, on a 10-year treasury, than in the low to mid fours. So yeah, we're still advising our clients that, you get four handle yields across the curve on long-term rates, 4 to 4.5, and anything above 4.5 is the buy zone for adding duration to their portfolios.
Which really goes to this question that we were asking earlier when we were peaking out in rates about how much these other concerns about the deficit, about tariffs, about a structurally more inflationary environment would really be problematic for longer-term bonds. I have to say, it's sort of a gut check for me because I hear things like Ray Dalio talking about civil war and the possibility of the U.S. debt completely undermining the value of the dollar. David Solomon with Jon Ferro earlier this week talking about how concerned he is about the deficit. Is this all just lip service to basically cover any potential risks that they have, but that everyone just sees this as continuing to be the same old story that isn't going to come to the market's fore?
I think of what a lot of people in the U.S., right? We're a very kind of nationalistic, U.S. centrist view here in the U.S., and it is a global bond market, and our clients are big pools of money all over the world. And if you look at, the fiscal situations elsewhere, they're at least as bad as ours. The supply is brutal everywhere. Europe's actually maybe a little bit of a shining star because they actually do have fiscal rules, even though they let them slip. But our rates, Lisa, our rates are 200 basis points higher than China, 200 basis points higher than German and European yields, 300, basis points, 350 basis points higher than Japanese yields. These investors control giant, sometimes trillion-dollar pools of capital, and a lot of them, especially, pensions, insurance, and sovereign wealth funds and central banks, they buy fixed income, right? And we are the world's bond market. And I think a lot of people in the U.S. forget that, and the dollar is still, one of the strongest currencies, and I think it's, when push comes to shove, global investors will look to the U.S. bond market for safety, and I think that will continue to hold true.
Well, Mike, let's focus on that. Let's just get into it just a little bit more. The buyers are still showing up. Have you noticed any change in the background of the buyers over the last 12 months? Is it becoming more domestic?
A little bit on the margin, Jonathan, but we're also seeing more and more interest now, just recently, from non-U.S. investors into the U.S. bond market, right? And remember, it's not just our treasury yields and our treasury auctions, because a lot of these folks aren't buying just treasuries, right? Yeah, in the auctions, it's a big deal. You need a marginal buyer to step in. But we have, the world's biggest, most liquid, diversified, regulated, attractive credit markets, which add a lot of yield and spread on top of that. And that's where you really see the demand. And that's one reason, to your point, Lisa, why credit spreads continue to be pretty tight. You have a lot of supply of treasuries, not a lot of net supply of private sector debt, meaning corporate debt, structured debt, mortgage debt, et cetera. So that could keep those spreads relatively tight. But, you know, on the auction size, yeah, I mean, they're gigantic auctions, and you think at some point there's going to be a failed auction, and we always worry about that, Jonathan. But, wow, we haven't seen it yet, and there's no empirical evidence that supply of treasuries in and of itself drives the level of interest rates. That is driven by growth, by inflation, and by the ultimate path of the funds rate. That's been the case in my nearly 40-year career, and it'll probably be the case for a long time.
If it changes, you're on the list of names we'll call first, okay? Michael Collins of PGIM. Mike, appreciate it. We begin with our top story. Stocks at all-time highs following the lowest inflation print in 6 months. Mahajan of Edward Jones writing this: if we see a Goldilocks cooling of the economy, markets may welcome this outcome. While this scenario continues to be our base case, the tail risk is a more rapid downturn that also leads to rate cuts, but for the wrong reason. Mona joins us now for more. Mona, if Walmart is doing well, what does it say about a broader economy?
Yeah, thanks, John. It does feel like it's consistent with the narrative we've been getting over the last several days, which is retail sales have been cooler. The labor market looks to be moderating. Perhaps more consumers are headed to Walmart to get that better discount. It does feel like the consumer feels a little bit stretched, but of course we're watching that lower income consumer more so than the broader economy. Now, keep in mind, both the labor market and the consumer started from a position of strength. So when we think about cooling, it's cooling from a very strong base. And so the scenario that we laid out, what we call a Goldilocks moderation of the economy, really means that the economy could soften a bit, but we're still talking about at trend levels, maybe slightly below trend levels. That kind of cooling also, keep in mind, can lead to better inflation trends. So if we are at the start of a bumpy ride lower in inflation, a Goldilocks cooling in the economy, that's an environment that the market will welcome. What they don't want to see is a more rapid decline, and that's what we're on the lookout for. We don't see it yet.
Well, what you're going through, and I think what you're setting up, is something we've discussed on this program for a while, the difference between a welcome cooling and an unwelcome deterioration. Can we turn to the labor market? What's the labor market telling you versus, say, what corporate America's telling you?
Yeah, I think the labor market's an interesting story here. Of course, at 3.8, 3.9% unemployment rate, still near multi-decade lows, so still relatively strong. But what we're seeing is better supply and better demand, or a more balanced supply-demand picture. And I think the Fed has highlighted this as well. We are seeing on the supply side more workers returning to the labor market, perhaps after that pandemic hiatus. We also have the immigration story working in our favor from the supply perspective. But we are also seeing job openings move lower. So the demand for that labor is coming down. The supply of that labor is moving higher. We think that will lead to a nice cooling in the wage gains figure. And that's what we really want to see for services inflation. What we'd say more broadly also on the labor market, some of those leading indicators, not only job openings, but the quits rates. Keep in mind, folks are not quitting their jobs like they once were, perhaps because there's not as many openings to go into after you quit your job. But that tends to be a leading indicator for the labor economy. We could see an unemployment rate tick higher, perhaps above 4%. But in our view, that is still healthy and probably not getting much more beyond that.
So dancing on the head of a pin of this Goldilocks type of situation that seems to be great for stocks no matter what, regardless of how far we push on either direction. What would trigger some sort of end to this Goldilocks that so far has been an absolute panacea to stocks, and you see it continuing to be?
Yeah, look, I think that's what we are all thinking about. We had our first correction earlier this year. It was only about 5.5% peak to trough in the S&P 500. What we were really thinking about is what would lead us to become, for that correction to become more nefarious. Would it ever turn into a bear market, a 20% plus decline? Historically, when we are in that environment, when we are entering a bear market or in a bear market, we tend to see a few factors in place. One, the economy is usually hitting a recession. We may not be in it yet, but we're heading in that direction. Two, the Fed tends to be raising rates pretty aggressively. And then three, there's usually that unknown shock factor, which is hardest to handicap. But I'd say when we think about the first two, either a recession or Fed raising rates aggressively, that doesn't seem like a likely scenario as we look forward. So Again, we don't expect that 5.5% correction to be it this year. We are headed towards an election season, et cetera. There could be more volatility ahead. But as long as we feel comfortable that volatility doesn't turn into something deeper or more prolonged, we think it's an interesting opportunity for investors more than anything.
In the meantime, a lot of people have been waiting for that pivot point to really start to broaden out. We are seeing some broadening out in specific sectors, but broadening out to small caps and some of the value names you see as really coming into play when we actually see rate cuts. Won't it be too late then? Don't you kind of have to get ahead of it?
Yeah, it's a good point. And look, I think as we get opportunities along the way, any of that volatility that we noted earlier, that is a great opportunity to not only diversify, make sure you're balanced in your growth value cyclical portfolio, but thinking about rebalancing, thinking about adding those quality investments at better prices. We do think, one, as we get closer to Fed rate cuts, that will be a catalyst to unlock a more sustainable broadening of market participation. But two, as we head to the back half of the year, what we're seeing in earnings growth is that earnings growth contribution becomes more balanced between those growth tech sectors and those cyclical and value parts of the market. Q1 and even Q2 to some extent really driven by tech, Magnificent Seven, outperforming on the earnings front. But as we get more balance on earnings, as we get closer to Fed rate cuts, and by the way, if inflation continues to moderate, that's a good environment for a broadening of participation, not only between growth and value in U.S. equities, perhaps international continuing to play some meaningful catch-up. And by the way, of course, your bond portfolio is starting to look a lot more interesting too.
Mona, you talk about the probability of September rate cut was moved up higher, but what do you make of Neil Kashkari yesterday basically saying we might need to stay here a lot longer?
Yeah, we think higher for longer should be the base case. And whether it's September, December, or even early next year, the longer for longer-term investors, the narrative really is the Fed was embarking on not just a 2024 rate cutting cycle, it was 2024, 2025, 2026. So a 2 to 3 year rate cutting cycle to get them at least somewhat closer to a neutral level. So we do think they are on that path for a multi-year rate cutting cycle. They will need to see as a prerequisite to that, as many of us have talked about, at least probably 2 to 3 better inflation prints. Now, we got a good one this week. Hopefully that resets the clock and we get a couple more in the months ahead. The one thing I'll say is I do think it's interesting the way the narrative is setting up for September, December, and then March. So this quarterly pace of rate cuts could be an interesting one for the Fed. At least it takes a little bit of the uncertainty out of it, makes it a little bit more systematic. If they can get the data to fall into place, I think that could be something they consider down the road as well.
Hey, Mona, appreciate the reaction to the earnings from Walmart and the commentary on the broader market. Mona Mahajan there of Edward Jones.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.